Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Today I'd like to talk to you about the use of cash by mutual fund scheme fund managers and how some that have very famously taken cash positions have actually got them to work. Of course, the opinion has been very starkly divided in the industry about whether fund managers should or should not take cash calls. And evidently, in certain cases, they work. In some cases, they have not worked. We're going to look at the data over the last 1 year and tell you what that has showcased. Of course, yes, we are talking about Parag Parikh's Flexi Cap Fund because their fund managers have very famously taken a cash call. Joining me to talk about this is Varun Fatehpuria, who is the founder and chief executive officer of Daulat Wealth Management. Varun, thanks so much for joining me for this very interesting conversation. And I asked you to pull up some data and you managed to do that. And the data actually speaks for itself. But I'm going to let you explain it because you've gone through the hard work of pulling this together. What does it tell you? Let's focus on the flexi cap space first. And you've picked 3 schemes. Why did you do so?
Firstly, thanks, Alex, for having me back on the show. I think cash call as a topic is something that's always interesting, especially in the market that we are today. So it's always good that, we look at data and see what the data tells us, right? So what we have effectively done is we have picked out 3 fund houses with varying degrees of cash position in each of the scheme categories that we have done. So we'll start with the flexi cap category, and the 3 schemes that we have picked is the obviously Parag Parikh Flexi Cap Fund. Then we have HDFC Flexi Cap Fund, and then we have thirdly the JM Flexi Cap Fund. And each of these 3 schemes, you will see the percentage of cash position is very, very different. On one end of the spectrum, we have Parag Parikh, which is very aggressive with the cash calls, having anywhere between 18 to 20% of the portfolio at that point in time still held on cash. Then we have somewhat of a moderate fund house with HDFC, where the cash position has ranged anywhere between 9 to 10% over the last 9 to 12 months. And then finally, we have JM Flexi, which typically likes to stay fully invested. So that is the reason why we have chosen these 3 schemes. It shows us the entire spectrum of the cash position, right from being fully invested to about 18 to 20%. And the data, what it tells us is very, very interesting. If we look at Parag Parikh, over the last 6 to 9 months, it has had anywhere between 15 to 20%. But if I start looking at the absolute return that these schemes have generated over a particular period of time, and even within this period, what we have done is we have taken the first 9 months of 2024, which was marked by a very strong bull market. Then from September 2024 to March 2025 is where we are right now in the correction territory. And then finally, the market cycle from January 24 to March 2025, that 15-month period. And what we'll see, the data tells us, is during the first 9 months of 2024, Parag Parikh Flexi Cap Fund delivered about 25.76%. HDFC, on the other hand, delivered about 30%. And JM Flexi, which was fully invested during that period, delivered a staggering 40%, right? So during this period, we could definitely see that cash is effectively causing a drag on the returns of Parag Parikh Flexi Cap Fund. But then if we switch gears and look at it from September 24 to March 2025, Parag Parikh has only fallen by about 3.1% due to that 20% cash buffer that they have in their portfolio. HDFC, on the other hand, with their 8 to 10% cash position, has fallen about 5.5%. JM, obviously, because it was fully invested, about 15.5%. This is where we are seeing cash positions actually shining. But again, this is best known in hindsight, given where we are today. And if I want to look at the entire period, Alex, from January 24 to March 25, Parag Parikh is at about 21.8%. HDFC Flexi actually beating this by about 22.6%, and JM Flexi coming in at about 18.5%, 19%. So over that full cycle of about 12 to 15 months, that significant cash position has actually caused a drag on the returns of Parag Parikh. Comparing it to HDFC, which has a bit of a moderate exposure, and JM, which likes to say fully invested, but is about a couple of percentage points from Parag Parikh, right? So the delta is not very extreme if you look at it from a 12 to 15-month period. But that is what the data effectively tells us.
And there are several takeaways from this, Varun. Thanks so much for explaining this so well. The takeaways, of course, are that I think a lot of people were around that September period, August-September period, talking about how Parag Parikh had started to underperform its peers because of the elevated cash positions that it was holding. And of course, you already said it, the wisdom of retrospect is flawless. When you look back and you look at the performance of the scheme over that 15-month period, it is actually comparable to an HDFC Flexi Cap. By the way, I'm sure you looked at this, and we only looked at 3 schemes in the category. How does 22.5 or 21.8% compare with the category average in that time frame?
So it is not too off. Actually, the reason why we have chosen obviously these schemes is because to show the entire spectrum from fully invested to moderately to sort of significantly underinvested. But we have seen that actually most of the fund houses do not take such aggressive cash calls simply because they don't think it is their mandate to actually take in equity money and then sit on 20-25% cash, effectively charging investors some sort of an expense ratio on a liquid fund strategy, right? So we have seen that actually the entire category average is not too off from what Parag Parikh has actually delivered at about 21.8%, despite holding about 20-odd% cash. I do not have the exact numbers off the top of the mind, but it is not a very, very big delta that we see right now. And it is only when we look at the drawdowns at that point in time, yes, you could see the difference.
And of course, we're talking at a time when they are still deploying or probably in the process of deploying the cash that they had, because over the course of March as well, there would have been opportunities to deploy and really catch that bottom as they were trying to do. The idea of holding cash is to try and catch the bottom, or at least from their perspective, what they've repeatedly said, and people that take cash calls, they simply say that, look, the valuations as they stand right now are simply not fitting in the ambit of what we think is appropriate, and we will deploy when they do look more appropriate. And I think that some might translate that to say that, oh, they're trying to catch the bottom, but I guess that's just how their model functions. Varun?
Yes, right. I mean, see, again, Alex, there are a couple of sort of sides to this coin, right? Our view also has typically been that any sort of an asset allocation decision, cash call decision needs to be taken at the investor level. If the investor is coming and giving an equity scheme his or her money, he effectively needs that to be deployed into the equity markets. If fund managers are of so strong a view that they are not finding opportunities in the market because of whatever reason, maybe the valuations are expensive, they're not finding enough opportunities, maybe a good idea could be to maybe just stop taking in fresh inflows, right? That is what a lot of the small cap schemes had actually done, if you remember, during even late of 2023, where they were constantly telling that the markets are elevated, we are not finding opportunities. And even from that period, the small cap had run up about 35-40%, right? So again, it is anybody's guess. I think if you look at the rear view mirror, I think the answer only becomes clear in retrospect whether that cash call was right. But when you continue to be in a period where the markets are roaring, this 15% underperformance that we saw up until September could be a bit nerve-wracking. I think investors at that point in time then, question that why is there so much of a divergence in the fund performance.
Absolutely. And those people that are familiar with the process that they follow would ultimately be okay with that. As is testament, I'm pretty sure, with those people that have been holding for so long. But it's not always, Varun, that it works, right? In some situations, elevated cash calls have not gone in lockstep with better returns than peers in periods of significant drawdowns. And that is evident in the data that you've pulled up in the mid-cap space. Walk me through that.
So again, FlexiCap, Alex, if we see, obviously it has shown some sort of a correlation between cash calls and the long-term return profile of the funds. But if we look at the mid-cap category, right, and here we have taken 3 different schemes from 3 different fund houses, HDFC remaining intact. We have taken Motilal Oswal mid-cap fund, which has been the top performer over the last 2 years. where they significantly and dynamically manage their cash position. So if I look at the June 2024 period, they were at about 5% cash. September 2024, they had jacked that up to 19%, but got that down to 9% in December 24. And now, as we speak, they are at 28% cash, right? Almost a third of the portfolio is cash, right? Nippon India Growth Fund, again, a good mid-cap fund, has typically liked to stay fully invested, and their cash positions have ranged anywhere between about half a percentage point to about 3.5. HDFC, again, on the other hand, moderately cash positions, so about 7 to 10%. We have taken the same period of return, so from January of 2024 to September, and then the 6-month period ending March 25, and then finally the entirety of 12-month period. If you look at the first 9 months, I think Motilal Oswal Midcap Fund absolutely blew it, 51.75% return. But in the drawdown stage of about September 24 to March 25, I think about 15% down, right? Compared to about 13% for Nippon India Growth and 10.5% from HDFC Midcap, which had a higher cash positions, right? But if I look at the entire cycle, Alex, again, from January 24 to March 25, despite Motilal Oswal Midcap, again, having varying degrees of positions, 30% return over a 15-month period compared to about 15 for Nippon and HDFC at 17.5%, 18%. So the answer here is not very clear, to be honest. Again, I think given that how Motilal itself is very dynamically managing its cash positions, and what we basically hear from them is they will continue to remain at this and maybe start only deploying it from April onwards, right, where they expect the markets to come back, right? So that's the data we have in front of us, at least in the mid-cap schemes, where the answer is not very clear. How effectively does it work, and when fund managers move in and out of cash?
Okay, so there's one particular scheme that we've spoken about in the flexi-cap category that has proven repeatedly that it does this on an ongoing basis whenever valuation metrics do not match. Of course, Motilal is doing it slightly differently, right? It's tactically allocating whenever it sees the opportunity to do so. And of course, the Motilal story is where they took aggressive bets in certain securities which didn't pay off, or rather which hurt them badly over that period of time that you've taken the 14% drawdowns on account of that. So perhaps if it wasn't for that one security or two securities, the cash calls that they had would have been more efficient or more effective. So perhaps that is also playing a part. The bottom line is what I want to come to now, Varun, which is what should the investor take away from this data? Would it be that if you know for a fact that your fund manager has repeatedly said, I will, if required, take cash calls, and you go into investing in these schemes with your eyes wide open, is that okay?
I think, Alex, ultimately investor needs to decide what their overall asset allocation profile is. If at the investor level, at the distributor advisor level, if the advisor or the investor itself are not taking cash positions, or maybe let's say they already have a significant percentage of their portfolio maybe into debt, or they're holding on to cash, and then they further go and give it to a fund house which actively believes in taking cash for, then there is a double whammy effect from the fund that he or she has invested into the equity schemes and already the cash positions that they are holding, right? So it is very important for investors today to understand which fund houses they want to participate in. As we could see from the data, again, the data speaks for itself. Over a market cycle, you as an investor need to ask what sort of an investor are you? Are you comfortable with that? Maybe even that 9 months of underperformance in Parag Parikh's case, where they were continuously and maybe consistently holding on to cash, that 12-15% drag on the returns. I think that is a significant amount, right? And it is anybody's guess where the bottom of the market is. At what point in time does the market cycle turn for the cash or for the fund manager to effectively start deploying cash into the market? So our view always has been that you understand your own philosophy, you understand the fund manager's philosophy, and then try and pick schemes.
Yeah, and this is very interesting data. Perhaps even if we look at it 3 months from now, Varun, it will be even clearer what we're talking about right now, and I think it's going to be an interesting conversation. Perhaps we'll couch it for that time. But thanks so much for joining me today, and a pleasure having you on the program.
Thanks, Alex.